So everyone has an opinion of what you should be investing in, but no one actually wants to test it out side by side. What we're going to do differently here is we're actually going to test out 6 different theories. We're going to be putting $1,000 a month into each of these theories, and we're going to put them month by month, side by side, and track and see which one actually comes out ahead. We're going to be putting real money, real results, and real data together, testing out, see which one comes out ahead, and the results might shock you.
All right, welcome back to Buy Your Kids a House podcast. I'm Andrew Higgins, and this is Matt Garlock.
Heyo.
And in our chapter deep dive today, we're going to be talking about investments, which I'm super excited for because we're going to actually be able to track and see the progress of our investments and see what's working for us and not working for us. And then we're going to be able to help share that information and data for you to better your family's financial situations and continue to improve upon it.
Yeah, absolutely. And if you're wondering why I'm wearing this shirt at the time of this recording for us, this is Dopey Week here for Run Disney events. For everyone that participates in an event, good luck to everyone doing that. Myself and my family will be going on doing that this weekend. I'm doing Dopey along with a few friends of ours. My kids are doing the 5K, and my daughter's actually doing her first 10K this weekend and everything. So part of our health and fitness side series we have with this, you're going to see, I'm going to be filming for that. And you're going to see, if you want to check us out on Instagram and our little side channels, you're going to see the journey of going through the expo, the different races and everything, and what it all is pertaining with the Run Disney events, with that also the finances of that. So look forward to checking that out. Hopefully join us on that journey as well. But for right now, let's go ahead and just dive into the investment side here and see what we're working with.
Yeah, let's do it.
So why we're doing this, so we know first off that for families, things can be really overwhelming when it comes to investments. So many different things between stocks, bonds, mutual funds, ETFs, crypto, dividend stocks. And we're not trying to argue about which is the best. We're actually going to line them all up side by side and actually test them out and see which one's the better one option to go with. So
yeah, and we're going to be using that same $1,000 in 6 different accounts. We're going to be using the same schedule for it, and we're going to be also tracking every month.
Yeah, and then from that, along this journey, you're going to be able to see the real results each month, which one's going to lead. And we're not saying to keep moving it around, but we're going to see over the long term which is the better strategy, and join us on there, and we'll build wealth together.
All right.
So now we're going to go into what the 6 different strategies that we previously mentioned and what each one's going to break down and look like. So the first one is going to be the most simple one, is simply investing in the S&P 500. For those that have read many books, like maybe like the Random Walk Down Wall Street, you'll see the base of the main strategies. You just pick a fund that goes into a certain market ETF and just tracks it over long term. So for this one, the first strategy, we're just following the S&P 500 with the ETF VOO. This is a diversified account, automatically gives you all the S&P 500 stocks all in that one ETF account. Simplest way to invest, set it and forget it, and get that long-term growth.
And our next option is going to be a mixed ETF portfolio, which also has the VOO, but also QQQ. It is a mix between S&P 500 and NASDAQ tech-heavy QQQ. It's a little bit more aggressive than option 1, but it still has way more diversified options as well.
Absolutely. So for our third investment strategy, we're going to be doing what's called the Magnificent Seven, as they're referred to. And for those who don't know, the Magnificent Seven are basically the top highest company market shares of these different firms that they have right now. So we're talking Apple, Microsoft, Nvidia, Amazon, Google, Tesla, and Meta. And basically, we're going to be investing in those and seeing, do we need to diversify amongst all S&P 500 companies, or are we good with just the biggest 7 playmakers in the field right now?
Yeah, and it's going to be a little bit more high risk, high reward, but they are perfect for this comparison.
So for our fourth investment strategy, it's going to be a crypto-only portfolio. Now, I know there are tons of cryptocurrencies coming and going every single day out there right now, but we're going to stick with the main heavy hitters at the moment. That is currently 75% of the Bitcoin and 25% of Ethereum. Now, with that, I have my hesitations when it comes to cryptocurrency, especially a lot of the ones that have the newer ones are popping up and going up and down. But we'll see, am I right or wrong in my theories with that? And we'll include that over the long term to see Ethereum, Bitcoin, how they play out, and if I'm right or wrong in my feelings on that. So
yeah, and we're going to test out if it's going to be better to invest monthly and just have that set amount automatically go into it, or if it's better to look at the market and time it with those ups and downs that it has.
So again, we'll see. I maybe not necessarily a fan of using crypto as your only investment strategy because of the volatility of it, but we'll see if I'm right or wrong. So that's part of the joys of a science experiment.
I was going to say, the data will show.
Yeah, exactly. So now we're going to do our fifth investment option, and that's going to be a dividend stock portfolio. Now, this is going to go to some of the more classic dividend stocks like your Pepsi, Target, Coca-Cola, McDonald's. So while there's tons of other dividend stock and platforms out there, we're going to stick with kind of the more old school mentality of that. And this is where your income portfolio comes from, and kind of the essence of what Buy Your Kids a House comes from. Because the idea is, if you're getting that dividend income, that quarterly, monthly income, depending on when you're getting your dividends paid out, could be replaced with a specific bill. But for this, we're going to track the growth of the actual stock and see where it goes from there. So
yeah, and this portfolio, we're going to start tracking what dividend income that we have from it, and we're going to be reinvesting it back into that stock to see if we can help it grow that way as well.
Yeah, so that'll definitely help for the growth portion, because right now we're focused on the growth portion, not necessarily replacing the bill portion yet. So
it takes time to get there.
Exactly. So our last investment option is going to be basically a mixed allocation portfolio. And basically, we're taking a little bit of the past 5 and combining it into one. And basically branching out, we're doing 40% into the same ETFs of VOO and QQQ. We're doing 25% into the Magnificent 7 stocks we had before, 20% into those dividend stocks, and the last 15% into cryptocurrencies of the Bitcoin and Ethereum. Now, this is where I'm a little more comfortable with investing in the crypto, because you still have 85% of what you're investing into core, more substantial stocks. And then you're basically using the last little bit to gamble, take a chance on it. Because again, if Bitcoin or Ethereum is the really grow, fantastic, you get your retirement faster. I just don't like the fact when you're putting all of it into crypto, and if it crashes, then you have nothing. So this is, again, obviously the science is going to lead us out. We're going to see what it's going to look like over long term. But this is the one that I feel, for my hypothesis, is going to be the best hunch to go with.
No, I agree. And when we're looking at like retirement, it's definitely going to be that ETFs or the Magnificent 7 ones. Those are going to be the ones that you want the long game in. And not that we don't with the rest of them, but those are going to be the ones to help with retirement. Versus the dividend stocks, those are the ones that we can grow to help your monthly bills and help right away.
Yeah. And if you hit big on the crypto, you retire early.
I was going to say, and then done.
Yep.
The rest of it doesn't matter.
I will say, we won. But if that cryptocurrency crashes, you still have a good chunk of your main funds to still back you up.
Exactly.
So
It's not, like you were saying, it's a lesser amount that's invested into the crypto, so you're not losing as much. But however, if it does come out positive, then you
won.
You won.
Exactly. So again, this is, if I was, my initial hypothesis, and yours could be different, but mine would be on option 6 for the long term at the moment.
Yeah, no, it definitely seems like it's the best option overall, because you have all of the different ones combined into one essentially, and you're not stressing out when things go real bad.
Yeah. So after this, we already have our first month's worth of data.
Yeah.
And we're going to dive in and see who's in the winner ahead. So go ahead and put in the comments now, predictions now, of which of those 6 strategies you think is currently the 1 month winner.
Yeah, let's find out.
Yeah. All right. So for here, we're going to actually show how we're tracking it. And we're going to have a little graphic coming up showing you in a moment here that we're putting in $1,000 every month. That started from December. So we actually already have our first month's worth of data here. So we put $1,000 in all 6 back in December. We put an additional $1,000 in the month of January. But so far, with $2,000 invested in each one up to this point, we have our winners and losers. And right now, the biggest winner currently actually is crypto. So the crypto-only portfolio actually went up a little, almost 2%, 1.73%.
Wow.
Over the course of 1 month. Followed by the dividend-only stock. Now, that one I'm surprised at, because none of the dividends actually have paid a dividend yet. It's just actual growth of the stock. So, add in a couple of months whenever they actually start paying their dividends out. That'll actually help increase that faster. So I'm pretty surprised by that. Follow that by VOO only. So the option 1, the strategy of just going with the S&P 500. And then in the middle part there comes the mixed portfolio, the option 6. The one I thought was going to be the overall winner, and might still be over the long term. We're only 1 month in. We're not talking about moving these around. This is going to be a long gain here and everything. But what hurt the mixed portfolio was my surprise. The Magnificent 7 and the mix of VO QQQ, both of those actually went down last month.
That's crazy.
So those two actually lost a little bit of money. Not a lot, just a little bit. And you'll see in the graphic exactly what percentages and everything we're looking at. But those two hurt a little bit, but this is also where I think the mix of option 6 helps out, because by having a little bit in each, yes, it may not have grown as much as the top winners, but it kind of hedges those bets, and that's why you want that diversification, and it helps protect you against that volatility.
Right, it helps it balance it out. And that is so surprising. I mean, we know crypto's unpredictable, and so it goes up and down constantly. But the fact that it was for the first month winner, especially after what we were just talking about, how we wouldn't hedge your bets all on crypto. But here we are, crypto is taking off. But I agree with you, we're playing the long game. It's not just the short, quick cash. It is over time. We want to build that generational wealth and see how that goes, to look at the rest of it and see, the things that we can potentially do in the future with it, and have those just continuing on. It's one of those, you almost want to put it on a back burner at times so you're not overthinking it, but keeping an eye on it like we're doing and tracking it. So where you can see the progress and see, like you just said, what's working, what's not, what's up, what's down, and having that balance it out, I think, is still the better option.
Now, you hit a point here and everything I think is also very important. Set it on the back burner, forget it. You look at it once a month, like we're doing. We're going to bring it up once a month on here. But this is not something to watch daily. Everything's going to go up and down, and you're going to freak out. And you may want to then sell, move things around, everything. This is a long-term game. If you're constantly trying to be a little day trader, and even if you're following these, which are more long-term ETFs or whatever, if you're still buying, selling, moving, shifting around, you're paying the fees to buy, sell, move, shift around, you're never going to time the market perfectly. So these are set it and forget it. I'm not saying don't look at it when you want to and everything, but it could definitely drive you nuts if you're constantly, staring at your Robinhood account on there, and like you're seeing the little chart, and the news comes out one day and everything just tanks for one day. These are long-term growth. And that's also why instead of putting a lump sum into these, we're doing $1,000 every month, because that consistently over every time will help you hedge those those quick short-term ebbs and flows of the market and everything. Versus if you had $10,000, $100,000 to invest a lump sum. Okay, then when that volatility hits, it can freak out a little bit. But when you're putting in consistently monthly money, whether it's $500 a month, $200 a month, even $100 a month, hedging that over long term will help you out versus those short term fluctuations.
No, exactly, and that's important, because to not freak out, like you said, because we're all guilty of that. It's like, no, my money is gone, and then
it's hard. It's hard not to wake up and hear the news. All of a sudden, something happened or whatever. Even a lot of these have their quarterly financial reports, so when they come out, also next day that stock dies because they didn't hit their numbers. But most of them, it's not. The following day, it comes right back up and everything. So you don't want to have that quick knee-jerk reaction of like, oh my God, it's down. Sell. Like no, you want to
sit on it.
Sit on, let it go.
Happens.
Now, if you're getting closer to retirement age, maybe shift more towards bonds, which we'll go into the difference between stocks and bonds later. But for right now, we're going to take that volatility and we're going to ride it out and see of this whichever works out the best. So.
Yeah, absolutely. Surprising results so far. I'm intrigued to see how it trends.
I am as well. I'm definitely surprised. Again, as I just bashed crypto about 5 minutes ago, here we are with crypto in the lead here.
Exactly.
Maybe Superman's dog is taking over and got it. But anyways, so that's what we're gonna keep tracking, and we'll keep touching on this every month and everything, because yes, we weren't down to everything. We're not going to dive into the different options as much in the future, but we're going to keep revisiting this every month and let you know where we're at in this journey. Because again, this is going to be a long-term journey. We're hoping, God willing, this podcast lasts 20 years.
Yeah, absolutely.
And our goal is over those 20 years, that's where we're building to hit that retirement growth. Now, with that being said, if you are later on in the journey, it doesn't mean to not jump in and join us. You can jump in these options wherever you're at. Like we're filming right now in January 2026. It could be years from now, and you're first coming across this. Doesn't mean not to start your journey then.
Correct. It's never too late to start the journey.
So again, the perfect time is the present time. So go ahead and open up a simple account on Robinhood, whatever your preferred portfolio option is. And follow us along and test it out. And again, we mentioned $1,000 for each of these. It doesn't mean you have to do $1,000. No. We're just using that for our own easy way to have those nice round numbers.
Right.
Off of previous ones of your budget, of your 20% of your income for investing, and whatever that number is, as I mentioned, it could be $100 a month, $500 a month. It could be $1,000 a month. Whatever the number is for your investment goals, that's what you're going to be putting into one of these strategies, or like we are with option 6, a little mix of the strategies and everything. So come along with this 20 plus year journey, hopefully, and we'll see where it takes us.
Hopefully in great places. All right. So on to the next.
Let's go ahead. So I think that kind of covers our initial investment strategies, the 6 different options we're going to go with. and we're going to track over long term. And while we're doing this, why don't you come on that journey with us and tell us in the comments, what is your hypothesis? Which one do you think of the top 6 options that we gave you think is going to be the winner? Bash me about crypto. Put in the comments there of what other crypto coins, because I will fully admit crypto is the area I know the least amount. I know a decent amount about Bitcoin and Ethereum. I have my other feelings on that. We'll dive into a future episode of what my feelings are on that. But when it comes to all these other smaller coins, Dogecoin, all these other ones out there, please put in there what your feelings and thoughts are, maybe what I should be looking at, maybe some good topics to look into. And then with that also what your experiences are with investing, if you're already doing in VOO, QQQ, or Magnificent 7 or any of these other ones. Maybe you've already had these for years and you've already experienced some growth, because put in the comments how much you've seen and grown, because we want to give the hope and encouragement to those in the future just joining us on this. So.
No, exactly. And like we said before, you start it when you're ready to start it, or when you see it, or you're ready to take that leap. It's never too late to do that, because your future self is going to thank you, and then your kids and everyone that you're wanting to build a generational wealth for in the long run, they're all going to be super thankful that you took the time to look at this and decide what's best for you. And that's what we're trying to do. We're trying to figure out all of the statistics and take that data and just figure out the best options for what we have.
Yeah. So let's build this generational wealth together. Go ahead and smash the follow button. Help us out. We're still trying to grow here. And please, if you learned something, share this with anyone else that you saw along the way. And if you put in the comments of what was your favorite part, what did you learn, what did you like, and everything. So we definitely appreciate the feedback, and we'll keep growing from there. And join us on this long-term journey.
All right. Till next time.
Bye.